Hello friends, welcome you all for our interesting video. I am Sundar from Canary Capital Solutions. The topic what we are going to see today is the most important topic and the question in almost in every investor's mind. Sensex already touching 60,000. Is it an all-time high? What should I be doing? Can I try and time the market? Is what the question running in many investors' mind. So let me try and explain to you, is timing the market really possible? And if so, how can you do it? And if you actually don't do it, what will happen? So theoretically, timing the market is definitely possible. So let me give you some recent examples. So during the Corona time, when the market fell to about 25,000 points, everyone was panicking, right? But after that, market started recovering. And the moment it was just closing closer to about 42,000 points, many investors actually were trying to book profits or exit because they thought it's come very too soon and it has come back to its previous level, so maybe it's the time to book profit and exit. And the same question came when the market hit 50,000. The same question came in when it was at 55,000, and the same question today at 60,000. I am sure the question is not going to change, but the markets have actually continued to rise. I'm not saying market will not fall, but all the time just trying to tell you is timing the market becomes very, very difficult. In theory, we all know that buying low and selling high is the most profitable thing to do. But when it comes to investment, it is very difficult because when the markets were falling during Corona, out of 100 investors, not even one investor would have actually invested money because he was already in panic and not really knowing what is going to be the future of this entire world, because we went through a huge crisis. And nobody invested, or most of them did not invest in when markets were actually cheap, which means we did not buy when markets were low. And similarly, today we all know that markets have reasonably come to a higher point. Many of the investors are actually trying to come in today and they are continuously buying today. There's nothing wrong about buying today, provided your time frame is 10 years from now. So buying low and selling high on theory looks very simple and easy, but practically it is very difficult because the way in which the market fluctuates, more than the market fluctuation, the emotions actually fluctuates much more. So every time you take a decision, it becomes very difficult because you are trying to take decision through the emotional angle, and money and emotions does not go well together. So out of my 20 years of experience in the capital markets, one thing I have always seen is investors are always fearful, whether it is bull phase or bear phase. So currently we are in some kind of a bull phase. Even today people are panicking, saying that should I be booking profit, should I exit, and things like that. When market falls also you are fearful. Of course there is a reason you should be fearful when market falls, but what I have seen is we are always fearful throughout the journey when it comes to capital markets. The same investor who has been investing money in gold has never found it fearful. Even if gold has not appreciated, whether the gold falls, whatever happens, there the investor is not really disturbed. If we can have the same kind of mentality or the mental frame when it comes to capital markets also, I think he will actually make much more bigger money than what he can actually make out of gold. Because the data suggests that a capital market gives you much higher return than gold at any given point of time. Market forecasting is a huge business for many of the business news channels. So their job is to keep creating content, so which perfectly works for the news channel. But as an investor, if you are going to keep looking forward for their forecast, there are enough data, enough instances available which clearly proves that no forecasts have actually worked 100% the same way. So there is actually no need to really look for forecasting. And some of the experts in the capital markets like Benjamin Graham or Warren Buffett, they've spoken enough about forecasting and they've just said it in so many words that don't look at market timing. This quote by Warren Buffett, who says predicting market in the short run is like poison. So keep it away from adults, because many adults try and behave like children. So keep that forecasting away from this adults. And again, Benjamin Graham, who is the guru of Warren Buffett, he says, on the hindsight, everything looks easy. Meaning what has happened looks very easy because the data is in front of you. But what is in the foresight, what is in the future is what the most difficult thing to predict, and that's where investors fail miserably trying to forecast things. So experts have said it in many number of occasions, in many other words, just trying to tell that don't try and forecast the market in a short period of time. So let me try and show you some data to substantiate what I have spoken about. So the chart what I am showing you is a 30-year chart of the Indian markets. If somebody just stayed invested, not really trying to time the market in the short run, what happens with Corona, what happens with the China, what happened to Lehman crisis, whatever. There are many things which had happened, and even the next 10, 15, 20, 30 years, there will be many such crises which will keep coming. But as an investor, if I just stayed invested in the capital market for the last 30 years, not really disturbing the portfolio because of the short term, he actually compounded his money at about 14%. But if somebody tried to time the market, as I said, theoretically it is very good idea, but practically it is very difficult. Even if you just miss 10 best days in the market, what I mean by best days is when the markets kept falling. If you just miss 10 days of fall and you have not invested, you just missed it, your returns actually falls to 10%, which means you actually lost about 4% compounding. Let me explain this to you. Over a 10 lakh rupee investment, if you just stayed invested all through the last 30 years, at 14% compounding, your corpus would be about 5.4 crores. Even if you had missed 10 days, your returns falls to 10%, which means your corpus will be 1.95 crores, which means the difference is as huge as about 3.5 crores. So this 4% can be a huge dent over a 30-year period. This is just by missing the 10 days. If you had missed the best 20 days, then your return falls to about 8%. If you had missed 30 days, your return falls to about 6%. If you had missed 40 days, which is just about a month or so, your return actually falls to about 3%, which means you would have been actually better off by staying in a fixed income product than being in a equity product, because your fixed income would have at least given you 6-7% return and not 3% return. And look at the difference absolute in terms of the amount. Your 10 lakh invested, if you had missed 40 days, your corpus would have become only 26 lakhs. Whereas if you had just stayed invested, not really trying to time the market, your corpus would have been 5.4 crores. So that is the difference. And as I told you, even the best of the minds who've been like the biggest investors never really tried to time the market, and especially in the short term, they are not even bothered about timing the market. And they are the ones who have actually created wealth because of their patience and the power of compounding. So timing the market is very, very difficult. Theoretically, it looks very interesting and a fantastic idea. But time and again, the data proves, and the best of the mind says, don't try to time the market. Hope you enjoyed this video. The next topic what we are going to see is about the 8th wonder of the world, power of compounding. Please subscribe to our YouTube channel, Canary Capital Solutions, and please don't forget to press the bell notification icon. Thank you for watching.